Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Thursday, the 16th of February. I'm Daniel Lam, your host for the podcast. Well, today we're going to change tracks a little bit. Instead of the broader asset classes, we are going to discuss the semiconductor sector. Why is that? Well, I'm head of equity strategy for the CIO team, and my teammates and I have been getting questions on this sector over the last 24 hours. No doubt, this was related to reports that Warren Buffett's Berkshire Hathaway has sold most of its holdings in a major global chip company. Now, last month, this chip company posted strong quarterly and annual earnings, but gave a muted forecast on prospects for this year, given the global slump in electronics demand because of rising inflation. And they are not the only chip companies experiencing this headwind. This downtrend in memory chip prices is likely to continue until the second quarter or even the third quarter for this financial year. And the impact from a potential US recession could hit demand cyclically. Moreover, due to recent rise in US-China geopolitical tensions, there are reports of the US government considering a ban of direct investments in certain high-tech sectors in China, and other countries joining the US in restricting the sale of advanced machinery to China. These moves are not surprising because there's increasing rivalry in the multipolar world. Now, for US semiconductor companies, China comprises 31% of sales. And while it is highly unlikely that all of these will be deemed quote-unquote high-tech, any sales restriction would have a negative impact on US companies selling to China. The negative impact could be mitigated if sales can be diverted to other countries. Indeed, non-China Asian companies could benefit if they can make the necessary semiconductor investments and sell end products to China. With decreased competition, they would be able to generate higher returns. Now, overall, the structural demand for chips remains robust, with AI grabbing more attention now, in addition to the digitalization and electrification trends. Thus, for long-term investors, they may consider targeting levels to purchase semiconductor stocks in stages. Looking at the Philadelphia Semiconductor Index, i.e. the SOX index, there is support roughly 8% and 20% lower from the current spot price. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.